starting with the ones that are temporal, the ones that are permanent. Temporal means it's temporal. It's for a particular time frame. It could be for 5 years, for 20 years, for 25 years. They usually don't go beyond 30, and not many companies do 30 years. They are normally around 20 years old. So that is called term. Typically, that is a temporal life insurance program. It has cost of insurance, meaning you're paying for, in case you die during that time of you're paying, the money, your beneficiary is going to be paid whatever the amount of your policy. So that is temporal. Now, with temporal, there is really no cash value. I say that, and I don't want to confuse the audience. Today, they are a hybrid of some whole life and temporal policies. They call them term plus LD, term plus living benefit. So it's overwhelmingly a term policy, and then they try to give you a little bit of some cash in there. But I don't want to go into that nuances here. Let's just think at the major types. Term is temporal. You pay for your cost of your insurance. Term is the cheapest kind of insurance out there. Then it's going to be low. If you have a term policy for 10 years, unfortunately, if something happens within that 10 years, they pay your beneficiary. After year 10 and 1 day after, that policy is gone. Something happens after year 10 and day 1, nothing happens to you. So nothing's going to happen. Now, you can renew a temporal policy. So you can go back and say, I want to renew it for another 5 years or another 10 years. What you need to understand is they are going to renew it at attained age. What does that mean? If you have a term policy for 10 years, at the end of that policy, you're 10 years older. Your cost of insurance is going to go up by a factor 10. I don't mean that you're going to times it by 10, but again, I don't want to go to it. They just know that your cost of insurance is going to go up by a factor 10 because you're 10 years older. Now, some term policies can be renewed at your age at that time without health evaluation. Please, if you have a term policy, go and look at your policy, what it says. I can't tell you that. You can send it to me, I'll help you with it, but I can't tell you. This is very important. Go and look at the policy to tell you if you can renew it automatically without further health evaluation. Some other policies, at the time of renewal, your insurance provider may come in again to do a health evaluation. I am here from Minnesota talking to you today. I'm healthy. I hope and pray I stay healthy. How do I know what happens to me in 6 months or in 1 year? So I may be healthy today. In a year, I have a condition that I want to, and I have the money to renew my policy. Your provider comes and do a health evaluation and says, you're high risk. You are no longer insurable. So if you have a term policy, you have to understand that. So you have to look at the fine print. Now, I transition from temporal to permanent. For permanent policies, there are 3 types. You have whole life, universal life, and index universal life. All of these 3 permanent policies, I already said all insurance has cost of insurance, so that you're going to pay that, regardless whether permanent or temporal, okay? The difference with the permanent ones are, as it says, permanent, so you have it for that time, right? It's not going to change for life. However, your cash value in the permanent policy, how does it grow? What mechanism is looked at to credit your account? What interest rate? That's basically where I'm going. For whole life policies, there is a fixed interest rate. So you have a whole life policy. They tell you, let me call myself. So let's say the insurance company will give you 2.8%, and it's going to be fixed. Every year, every quarter, they credit your account by, that year ends by 2.8%. The range in general for permanent policies are around 1.8 to about 4%. Most of them plateau around 3.8. Few out there are 4%, but that's your range, okay? There's going to be 6. Look at your policy to know that. That's there. Now, let me transition to... Sorry, go ahead. Was that a question concern?
Yes, I think the person was just saying that he's in. I just arrived.
Okay.
Yeah, go ahead, please. Thanks.
Now, with Universal, your account will be credited at a flexible interest rate based on what is going to be stipulated in your policy, whichever stocks, variable. So basically, the stock market goes up at that year, that month, that quarter, they credit your account higher. The stock market goes down and it can go negative, by the way. So your account will be deducted. So that is a flexible account. You have to understand that. The third is the Index Universal Life. And I think there's been a lot of talk about Index Universal Life, recommending this one. Your cash value is based on an index. What does that mean? The basic difference between an index and a stock is you can go and buy a stock and invest directly in one. You can just to call companies, Walmart, Caterpillar, ExxonMobil, what have you. You can buy it on the stock. Now, the average of particular companies that are participating, the average of the stock of those companies that are participating in that particular geographic area. If you think of maybe the United States, it could be the Dow, the top 30 companies in the US, the ExxonMobil, Apple, and stuff. As their stock go up, they average them. Most of them use the S&P 500. So that's the 500 top companies in the US. They average their stock. One is up, one is down. The average of that 500 is called an index. So your insurance provider looks at the index and credit your account based on the average of the market. Okay? One other benefit or understanding of the index is that you're going to have what is called a floor and a cap. So remember I said that is the average. So the average sometimes could be 20%. The average sometimes could be negative, right? The market goes up and down. Most of the Index Universal Life products, they have what is called a cap and a floor. So they're going to tell you that regardless what happens in the market, they will always give you a particular percentage rate. Most of them do it at 0.5 or 7.5 to 1. So that means, let's just stick to the 1%. So your floor is 1. That means that your account is never going to be credited below that percentage, regardless what happened in the index. It can be negative, but you have a guaranteed 1%. On the top side, you also have what is called the cap. They're going to tell you that they're going to give you 10%, 13%, 14%, 15%. Look at your policies, please. There's a cap depending on the company that you go to. What does that mean? If the market, the stock market, the average, in this case, the S&P 500 ends at 15%, they will not give you 15%. They will give you your cap, which is 10%. On the negative side, if it ends at negative 3% or negative 8%, they will not deduct money from your account. They will still give you your guaranteed 1%. So most people look at it and they say, you know what? The market can go up, the market can go down. I have this window that I know my money is always going to be created. 1 to 10%, 1 to 12%, 1 to 50%. Look at your policies. And they are comfortable in picking this one. The average of most of these accounts, you can look at that 6%, 7%, 8%, 10%. Those are the average numbers, right? Over the course as that product has been out there for that particular provider. If you compare the Index Universal Life average and the whole life, which is 6, I told you that the whole life is anywhere from 1.5 all the way to 4%. That's your range in your full life. There is going to be 6. Yours can be 2%. It could be 2.5%. It could be 3.8%, right? Then you look at the range of the Index Universal Life 1 to 15%. You're seeing that with an index, you have higher probability of getting a higher interest rate for your account to be credited. So with all the other additional, I don't want to go into riders and stuff and all that. With all the other things that all the other experts explained during the Africaonline forum, that is why most of them are saying if you're thinking of life insurance with these four major types, index universal life should be something that you should consider. I say that and then also follow up that that does not mean that it is suitable for everybody, okay? There is one temporal term, the second one is whole life, the third is universal life, and the fourth is index universal life. Those are the four major types of life insurance products. I will, if people want to follow up, go ahead. If you want to follow up with some specific questions, that's fine.
Yeah, I was going to say, of these four, which is the best for a starter, somebody who is just trying to sign up for a life policy? And also, just to, as a follow-up to that, is age a factor in signing up for a life policy?
Okay, yes. Age is always a factor in signing up for a life insurance policy, regardless the type. The cost of insurance that I mentioned is based on three things. One is your age. That's how they calculate the cost of your insurance. The second one is your sex. Males pay more than females because us males will have a shorter life expectancy. We're also riskier. The way we drive cars, the kind of we drink more, we smoke more. So we have a riskier life in general than women. So that is cheaper. The third thing that determines yours is health. You have to be of good health. There is a health risk. They come and do a health evaluation, and they're going to classify you at a particular risk level. So your low risk, your insurance is lower. Your high risk, your insurance is higher. So those are the three. So age is definitely a factor. With an age recommendation, the sooner the better. If you are contemplating about it, go into it. If you think too easy, it's good to think and evaluate that. They don't take years because your cost of insurance is going to go up. To your first question, which I'm answering secondly, is which one would you recommend for starters in general? Now, that in general is the index universal life is something that in general you want to look at. And this is why. You have your death benefit plus 2/3 of living benefits in that policy. So it's a policy that you may, I would say, rarely go wrong. I'm not saying that it may not be suitable for somebody, but it's the general question. For starters, look at that. Start with that. Understand what it is. Now, this is when you say for starters, and I want to break down that for starters. If for starters means somebody that does not have a lot of knowledge about life insurance, then yes, once you sit down with that person and break down the benefits, limitations, concerns with the index universal life, they will most probably go into it. Now, for people that generally have kids, that's also something to recommend. If for starters means somebody that maybe is relatively young, out of high school, fresh out of college, maybe still looking for a job, and fortunately, however you want to look at it, you started a family, but things are financially, you're not there yet. That's when we say, okay, have a term policy. It's better to have something than nothing. So if the concern is really cost, because at that time, that's what you can afford, get term than nothing. Once things change, transition from the term and look at a permanent policy in general. Definitely, you have to sit with every person to try to understand that. But I thought it was important to break what for starters for starters means in the the different scenarios.
Indeed, it's very important. Yeah, thank you for that. Yes.
I have a question.
Sure.
Yes.
Let's become
Yes,
go ahead,
yes. Hi, this is Ambronzo Santo. Thank you, Mr.
Okay.
Bonga.
Yes. You're welcome to the program this Sunday.
Thank you. So, if you had a term insurance, just to follow up on what you just said, say a young individual or somebody who can't really afford, because I'm assuming that the permanent, I know the cost will depend on the age and everything else you've said, but I'm assuming the permanent insurances are probably higher in terms of cost compared to the temporal one. So if you wanted to convert from the term to one of those permanent ones, let's say you went in for a 5-year term, okay, and then now you're like, okay, well, I think I see now the value in the index universal life insurance, and you want to convert, and say you were 3 years into your 5 years, do you now lose that completely? Whatever, is there any, can you convert without losing? Well, anyway, you said term was actually, with term you actually, there's no cash and value in it. Now, let's say you were converting from a whole life to a index universal life insurance. Can you, if there was any cash, if you were supposed to reap any benefits from that, can you convert it to your new index universal life, or do you kind of lose that since it's a completely different insurance?
Okay, thank you, Dr. Brahida. Welcome to the program. When you are asking the questions of converting term to an index universal life, I was thinking that you're talking about me, but this is what, and I want to highlight the cost thing a little bit, and again that was my thinking. That's honestly why I'm very passionate about it. We get so focused on the euro, the CFA, the dollar, the yen, or whichever currency that we're using. We look at that, and that's what we focus on. If they add $1, 1 pound CFA, 2 euros to it, we don't want to listen to it very much. We say it's more expensive. And I'll generally say this, especially from our African community, which generally go to term. Term is the most expensive policy that's out there. I'll say that again. Term is the most expensive policy that's out there for you, the consumer. This is why. When I say most expensive, again, you go to the dollar value is less. The question is, what are you paying for in a term policy? Your $50, your $20, your $25, what are you paying for? Your definitely is protection for life, for your life, and that's important. But we don't plan to die, we plan to live, right? However, the reason why term is so, the reason why term policies are quote unquote cheap is because the insurance company, the statistics show that you with your 5 years, with your 10 years policy, you will definitely outlive your policy. Meaning that if you have 5 years policy, you will live up to 6 years. And you basically paid that money and you did not die. The insurance company pays less than 3% of the time for term policies. What does that mean? 97% of people that have term policies outlive their term. The money just stays in the insurance company. Everything that you paid is gone. And I think you ended with that understanding that there is generally no cash value in a term. You're paying only your cost of insurance. If you have a 5-year policy, please die within 5 years. Okay? Please, my brothers and sisters,
unfortunately,
die
nobody
in
wants
5
to
years.
die.
Exactly.
Nobody wants to die.
That is the only way that your family, your beneficiary benefits. Outside of that, you're throwing money out of the window to the insurance company, thinking that is cheap. Okay. No, please, no, don't die. No, that was a joke. You understand what I'm saying?
Yeah, we understand.
Yeah. Now, with regards to, but again, I go back in saying there's a place for term. Young family and stuff, give them that. Okay? in general, once we start hitting 32, 33, 34, 35-ish transition as a later, 32 transition out, because again, you start getting older, your policy keeps going, right? And if you people that come out of school and college by 20, 21, 22, 23, 24, they're finding their lives by 25, maybe they have their second, first job, and by 27, transition that. But go back to your question. If you have a whole life policy, or if you have a policy that has cash value, yes, you can convert that policy into, for example, an index universal life without losing your cash value. You can take the money that you have in that policy to a new policy without losing that. The recommended way to do that is what is called a 1035 exchange. So your new policy, the person that is going to be selling that policy for you is going to ask for your current or your previous policy, the policy number, your name, put everything in with the 1035. I don't want to get technical with this, but that is preferred because once you transfer the money, you don't lose your cash value with the 1035 exchange. There's another way that you can also get your money out of your insurance product, which is you can call your insurance company and say, okay, send me a check to this other place, but what's going to happen through that approach is they can only send you what is in your cash surrender. What does that mean? That's the money that you can pay your living in, depending on how old your policy is, how much you've been putting into it. But in general, your cash value might be higher than your cash surrender. To call numbers, you might have $15,000 in your cash value and your cash surrender is $7,000, right? If you want to take money yourself or you call the company, they will send you your cash surrender. You will not, so you lose that cash value, which is higher. And then the next thing that you have to know is that you will have to pay taxes on that because you're stopping that policy. I know that's not your question, but I'll explain that. So
that was my next question, actually.
Okay. Yeah. So if you yourself, you say, hey, you can make a determination and say, no, I don't want a life insurance anymore. And that's fine. That's your decision. You call the company, what is in your cash surrender, they take it and give it to you. That is what's going to happen. You will not take what is in your cash value, they will give you your cash surrender. The next thing is, you have to declare that with the IRS. You have to pay taxes on it. And this is why. If your life insurance product, which you're trying to use as an investment vehicle, you can take that money out without paying taxes while your life insurance policy is still living, it's still alive. If you cancel the policy, you will take your money out, but there's no more life insurance, so you lose that tax advantage. You have to report that as regular income to the IRS. The government wants Uncle Sam or wherever you're not, if you're in Cameroon, you're going to pay taxes on that. That's how it works. But to your question, yes, you can roll over, you can get your whole life policy into an index universal life policy without losing your cash value through the 1035 exchange process. No taxes paid to anybody. That is a recommended and preferred route. But you can do the other one too.
Another quick follow-up. You said the term insurance is, you give an example as for those who may benefit as maybe young couples. Don't you think somebody who is maybe about 70 years old or 80 years old who decides that they want
That's a good follow-up. Now, when it's good you actually brought that up. Most times, right, at that age, when we are younger, this is a fundamental question I didn't get into. Why life insurance in the first place? Why? Most people want it for protection for yourself and your family. Protection for your life, health, and disability. That is important. You want to protect you. Something happens, that's protected. Your kids are still very young in your earlier years. If something happens, at least somebody's going to come with a bag of money that can continue with their life. It's not going to be the same without you, but at least something's going to be there. In the age group that you mentioned, and I thank you for that question, 76 and above, at that time, most of those people at that age group, their kids are adults already. Okay? So at that age, the reason in general, 90% of the time why people at that age are looking for life insurance is death benefit. It's not living benefit anymore for anybody. It's death benefit. So to have that protection for their life, their burial expenses, what have you. So then at that age group, term makes sense too.
Okay, Mr. Bongwa and the listeners,
Yes.
we will come back to the discussion. Just to give Mr. Bongwa the time to have a sip of water. I know he said it was quite hot in Minnesota today. We'll take a break. It is the top of the hour, 4:01 by my watch over here. And we'll invite Reverend Palm to make those important announcements that we usually make on Sunday afternoons at 4 o'clock. Reverend Palm, are you with us?
Yes, I am. Thank you so much, Nia, and of course...
Thank you for all the good work you are doing for the people of Houston who have been hit by that Hurricane Harvey.
We thank God. And I want to especially thank Mr. Atancho. Celestine, thank you so much for, sharing your knowledge. Some of it is intellectual capital that you are sharing with Africans and for Africa. And that's what this forum is all about. We want to appreciate you. We want to thank all our participants, all our members. This is Members' Choice Month, and I'm so glad, the members suggested this topic. It's like a no-go area for Africans, and I'm sure this has all been discussed. I was on meeting in the world. So, and Mr. Atento, thank you for taking back that thing about somebody dying within 5 years, because Proverbs 18:21 says, "Death and life are in the power of the tongue." And in Psalms 91, verse 16, God says He will guarantee all of us long life. So thank you for taking that back before somebody decides to kill themselves to collect life insurance, even though that will not benefit them. So we are really, really grateful. You see, that's why we have this organization, because Africans, how many Africans even know that we have Africans that know what have been this much about insurance, life insurance, term life, death insurance, there's no point accumulating all that money and you cannot benefit from it while you're alive, So I really, really, on behalf of Africaonline Media Corporation, I want to extend our gratitude. And please, invite some of your friends, some of your colleagues. We have a lot of intellectuals in the African community, and we need to help our people. Thank you so much. That being said, like Nia always says, the next topic will be African parenting. It was also suggested by a member. In Proverbs 22:6, the Bible says, "Train up a child the way they should go, and when they grow up, they will not depart from it." But we know that a lot of us African parents in this country, we don't raise our children the way our parents raised us. We've had children that call their parents by their first name. They talk back to their parents. Somebody mentioned to me how, there was a parent that was, the parents were sitting in the car and waiting for the children to finish up their makeup to go somewhere. And I'm like, that will never happen in my household. My daughter, I don't care how many PhDs she has, she will never disrespect me. She will never talk back to me. She know who brought her into this world. I think there was some African-American woman who said, "I brought you to this world, I can take you out." I'm not going to take anybody out. I'm not suggesting that parents should murder their children, but I think the parents need to make sure the children know who the parent is. So that's what we're going to be discussing next Sunday. And we want to encourage everybody, invite your friends, invite your neighbors, even though Africaonline is for Africa by Africans, non-Africans can dial in. However, our experts are all Africans, because it's about time we start taking care of our own issues. Don't we agree? We depended on the West and the East for decades, centuries in particular. So it's time for Africans to know that they are actually brothers and sisters, daughters and sons of the continent that have the solutions, that have the answers, that have the wherewithal for all the issues that affect us Africans. So I am so grateful. And Dr. Bonhida, with your permission, I would like to introduce you as our point physician for our medical squad. I want to personally thank you, for all your participation, for your seed, not just, intellectual, also financial. So we are very, very grateful, for your dedication to Africa and Africans. Thank you so much. Over to you, Nia.
Thank you so much, Reverend Pam. And this is Africa Online. We are on YouTube, we are on WhatsApp, and we are on this live broadcast. Please join us, ask your questions. It is Africa by Africans, and we want you to hear from your own brother. Maybe that will make a difference in your life. That being said, we're going back to Minnesota to get our experts. Celestin, please. I know you've had a sip of water, you are rested, and you are ready to go. I think there was a question that you were answering before I cut you short. Please go ahead.
Yes, thank you. Thank you for that, Nia Song, and the lady from Houston that brought that information. I think I kind of rounded up with the issue that came from Dr. Brown Hida with an elderly person. I remember maybe 65,
70 years.
Term. Yes, each term would not be appropriate, and yes, by all means, a term would certainly be appropriate. And I kind of clarified, the reason why. In general, people at their age, my dad, actually visited me here in Bamenda and was here. He left about 10 months ago, and before he actually showed up here, I got something established for him, and he was done. Now, the reason I go to that example is saying that, yes, people at that age, I'm an adult today, so the reason for establishing a life insurance policy for him was primarily death benefit as a component. That was not something that he needed. He doesn't need it again right now. I mean, we're fortunately all grown up. The next thing I want to, before turning it back again to questions, please, or clarification on this particular point, I want to go back to the education. Like I said, September is Life Insurance Awareness Month. I certainly respect the topics that Africaonline puts on a weekly basis. Next week, from what I'm hearing, is going to be a different topic, and we'll have to respect that. However, what we do, what I do is really financial education. Life insurance is a component of it. It is an important component of it, but in the grand scheme of things, life insurance in itself for our financial education campaign stands about 20% of the education. If people are interested to learn more about the educate themselves about life insurance beyond this week and in general, financial education, the excerpts of the book that I put when I explained a little bit about life insurance, I can work with those people and send them some copies of that book so they can. It's 85 pages. It's a simple read. We're all busy. I'm going to identify 10 to 15 pages for you to go through. And in our awareness campaign during this month of September, I am making myself available through the month of September on Mondays, Tuesdays, and Saturdays. I repeat that again. I'm going to make myself available on Mondays, Tuesdays, and Saturdays for feedback, questions, and answers. Not on the Africaonline website. I mean, there's an agenda there, there's a timetable there that we have to respect. But for this month of September, for life insurance awareness for our financial education, if people are interested, I'm very committed in pulling that off. The only thing in terms of a ladies or gentleman's agreement, and I'll explain why I'm saying this. If I make this book available to you, please look at it. It doesn't help me. It doesn't help you. As a matter of fact, it will not help the next person. If this book comes and you take it and put it on the shelf and you don't look at it, there's somebody out there that should have been looking at that book. If you have questions, that's my availability that I have laid out. If not, beyond September, we'll try to arrange to mail the copies of the book back to me. For those people that may not have the time to look at it within the month of September, for those that have the time to look at it, you can keep it and you can share it with other people. This is why. We have a campaign going out of financial awareness. it is not a book to put on a shelf. It doesn't do us, it doesn't do you, it hurts the other people. So we want them back. And the reason is we want to give it to other people that want to look at that. So
thank you for that. Yeah, thank you for that. Just to rub in on what you are saying, for those like me who don't buy a chicken in a bag, because the Bangwa man is very skeptical about buying things in a bag, they can go on the African WhatsApp group and see some of the excerpts you posted during the week. That will encourage them to order the book or to contact you for that book, because what I read enlightens me more than listening to somebody talk to me face to face. Because I like to hear, I like to see, I like to read, and I like to listen. So please, you can also go on the WhatsApp group and check out the excerpts he posted, and then of course you can contact him. Maybe you'll give them your contact before we wrap up this program. So please go ahead now. I had this question. Is there a time limit between when you sign up and when you want to opt out? Should you wait for 10 years before you want to opt out, or for 5 years, or for 2 months?
Oh.
If you sign up for, say, for a term life, how long does it take before you can say, oh, I no longer need it, I need to take my money back?
Oh,
you take money back.
It's good you actually narrowed it down to a term life. So there's really, and we go back to the understanding. For a term policy, your premiums, once you pay your premiums, that is the cost of your insurance. That's the determination. So there's really no...
But when you make the determination, are you not losing what you already contributed?
Oh, okay. So again, I'll explain it for term and then move to the other ones, right?
Yeah.
For term, your premiums is just for your cost of insurance. There's no money in there. So there's nothing to gain or to lose. There's nothing to lose. So you don't have cash value in a term. So once you stop, basically your coverage ends. To be more specific, let's say you have a 5-year term. After 1 year, you stop, and then unfortunately, so you stop paying. Unfortunately, something happens to you at year 2. The insurance company is not going to do anything because you stop payment. Okay, so you basically you're stopping your coverage. Now, if you have a permanent policy, either a whole life, a universal life, or an index universal life, and you have some cash value in it, and you decide that I want to stop now, they will look at your cash value, but because you're canceling the policy, they will give you your cash surrender, not your cash value. Policies that are in the, I would just say typically the first 3 years, typically, your cash surrender is very, very low compared to your cash value in your policy, what you can actually take out. Now, of course, as your policy grows, your cash value goes up. Once you decide to cancel the policy, you don't want it anymore, they will give you your cash surrender, what is in your cash surrender. That is the law, they have to give it to you. Now, remember one thing that I said already. You're canceling it, right? So you're going to be taxed, because life insurance, you don't have the tax freedom anymore. You will be taxed for it, but you have to understand that.
It's understood. So, yes. Yeah, go ahead.
Yeah. So the time frame. Once you're canceling, they will look at the amount that is your cash surrender, and by law they can't keep it. They will give it to you. So that's the answer to that question.
Okay, please. Any other contributor wants to ask a question, please? We need your question. The time is running down. About 15 minutes to go, please. Ask your question before we end the program for today. Yeah, also, you're welcome, and thank you for being alive and surviving Harvey. Harvey was so devastating. Thank you so much.
Thank you. To Mr. Celestin, I just had a question on when you're talking about the index insurance policies and the universal. Now, you said they gain value the more you put into it, or what you earn. My question is, on some of those policies, I know they're going to be more expensive, obviously, with the premium, but even with the value you get with it, is there any kind of, investment costs, like other back-ended fees that you don't see up front that you have to deal with?
Go ahead.
Because what I'm saying is, it's obvious that, I've seen multiple different policies that would say, yes, we guarantee you at the bottom would be like 15%. But what you don't see is the fees that are attached to that. So you might not end up making as much gain as you might think on some of those policies. Is there a way to find that out before you start? Let's say that's what I want, or that's what I want to invest in, or that's particularly what's going to be the best fit for me. Is how do you know all the fees that are going to come to buying those policies?
Okay. Great question. I really thank you for that question, because one of the contributors on the forum, I think I don't know if it was he or she, but was alluding to the point of not really hidden fees, but talking about agents in general, comparing them with car salesmen or what have you. This is how you can find out. Or before going to how you can find out, once your policy is established, these are the three things that you will generally have at a minimum. Your cost of insurance for the first year. And before I even break that down, yes, you can find that out not only once setting up the policy, but before you set up the policy. Tell you that the purpose of this education is to put you at the driver's seat, because all those things are in the policy. Once you ask those questions, the other person at the other side of the table knows that you're informed. You can find all that out easily. But these are the three things that you're going to find 90% of the time. The first thing is your cost of insurance for the first year. Your cost of insurance for the first year is generally higher as when things start going down. The reason is you have administrative fees and account set up charges for that account. Now, listen to me. Cost of insurance, admin fees, and set up charges. Once you set up that account the first year, you don't set up that account every year after, right? You cannot be setting up the same account every month because it's already set up.
Yeah.
So you look at that and it is broken down. Your cost of insurance, admin fees, and setup fees for the first year, you have it all tabulated. Now, year 2, year 3, year 4, you will have cost of insurance, which is, you're not setting it up again. So all this is in there. Now, for the index universal life policy, you will have, the breakdown of, just say, 1/3, 2/3, right? 1/3 goes to your cost of insurance, 2/3 to the other investment vehicles. So you will see an illustration projecting, year for year how much you can make. Again, it's a projection because the year hasn't ended, right? But your question about the cost and the fee, yes, you can know all that. And in all cases, it is actually in your policy. The thing is, sometimes we in the industry don't take the time to explain to people. And then sometimes people don't take the time to listen to us. Regardless what the issue is, everybody on this call, please take this. If you want to set up anything in this case, we all have, I say we, I got into this thing 1.5 to 2 years ago. I consider myself at the other end because of the things that I wasn't doing, I wasn't thinking, what have you. The power is for you to have, going back to this financial education, once you ask 1 or 2 questions to the other person on the other side of the table, they know that you have an idea of what you're talking about. I'm not saying that the people on the other side of the table, they are great ones, they are good ones. But regardless, how am I going to say you're going to meet a good one, or a bad one, or mediocre, or what have you? But I want you to always have the right policy for yourself. How do we both do that? Educate yourself. Educate yourself on how, the concepts of, I know we do all different things, but there's sometimes that, you want to work with us, you're going to learn that, and you can take it and know how to dissect, and you don't even have to know that. Ask the right questions and will be given to you. Going now back to your question, cost of insurance, administrative, and setup fees. And yes, they are all in the policy before you actually make make a determination. At the latest, once you have that policy, which is multiple pages, yes, in most cases, it's in the fine print. You and I cannot change that because the provider, they're going to do that. But you and I can understand how it is written. It is all in there. I don't know if I answer your question.
Yeah, you answered my question. The other last thing I just want to say, like, I don't know if you covered this because I had to step away from the console for a moment. But the other question I had was, how do you determine what is the best, like, the amount to get? Let's say you decide to get the universal or the index. How do you determine the amount? Because somebody like me as an individual, okay, yes, I know 250,000 or 100,000 would fit me, but it might not fit a family of four that has a mortgage, credit card debt, cars, children, tuition, different things that come into play in the actual real playing field. So do you encourage them to go higher, where they go to $500,000 or to $1 million? And then even if they go up to that, what is the cost for that every month that they're trying to do those policies?
Okay, that's a great question. I didn't get your name. What was the name again? The amount of insurance. How is that determined? And I sent something out there. I'll answer that. We buy a car. You cover a car. There's a cost. You're sitting in a home. It's maybe a $200,000 home. So you cover that.
Correct.
You buy cell phones. You cover it with flat screens. There's a cost. Now for humans, what's the cost? How do you determine that? And you kind of mentioned some of the things. And one of the excerpts that I sent out, it is called the dime method. There is a way to calculate your amount of protection need. Because how am I to look at, listen to Dr. Brownhill that said earlier and say, okay, hey, Dr. Brownhill, that your policy is $1 million. And now you just spoke and I say, Uzo, your own policy is $2 million. Where is that coming from? Now, for you, if you're single, you're not married, you don't have kids or what have you, it's going to be determined differently. And as you also said, if somebody has kids, there are other things that you look at. But to go back, what we use is called the dime method. The D stands for debt. You look at your debt. If you have debt, you want to protect that debt. And sometimes a marriage or what have, depending on what you have, it could transfer to somebody.
Right.
So you want to make sure that it's protected. I is income. You take your annual income, multiply it by 10. Where does 10 come from? The Bureau of Labor Statistics shows that in general, especially North America, Europe, and other places, and I'll even argue from where we come from longer, it takes about 10 years on average. Once a family loses the primary breadwinner, it takes about 10 years for that family to actually bounce back. The other side is even worse, and I say this: if you are living and you have a protracted illness, you are temporarily or permanently disabled, and God forbid maybe that did not result from your job, what happens? You can no longer go to work to get that money, so what happens to you? God forbid you have a family, right? So it's not just about dying, folks, it's about living. Take your income, multiply it by 10, and know that you factor that in your protection need to calculate your insurance. Now, you mentioned mortgage. So I'm not going to, that's the M in the dime. Mortgage, or if you're paying rent, right? Something happens, you still need a home, or your family needs a home, or wherever you're renting, they need a roof over their head. You want to protect that home, that mortgage, that rent. And then, education. Are you thinking of yourself going to college, university? You have kids that will go to university, college one day. University, college is expensive. If you have one kid, it's factored in. If you have two, it's factored in. If you have three, it's factored in. You go to debt for D, I for income, M for mortgage, E for education, dime, and then you calculate your actual protection need. That's what you take to the insurance company. Think about it. You transfer, insurance is all about transferring your risk. You say, oh, I want to protect $1.5 million because this is what I want to ensure that my family is going to be covered. They're going to go to school. I'm going to stay in this home. I'm not going to beg, regardless if I work or not. The insurance company says, okay, that risk that you have now, give it to us. If the insurance company takes a risk of $2 million, gives you a policy, you're paying monthly or yearly, however I want to do. If any of those things happen, the insurance company is going to come with a big bag of money to ensure that the risk that you transfer to them is going to be executed. Does that make sense?
Yes, that absolutely makes sense. And the way you put it, that actually does make sense. Because I was thinking the law of 72 is the same thing, which is the same aspect of how you calculate your debt to life ratio.
Yeah, the rule of 72 is a little different. So what the rule of 72 tells you in most cases is if you take the interest rate, in this case on your insurance policy or you're getting at a bank or wherever, if you take 72 and divide by your interest rate that you're getting, it's going to tell you how many years it's going to take for your money in the savings account, right? So you have $5,000. You take 72. I ask you that, what is your interest rate in that savings account? What is the bank giving to you? Now, in the United States, which are the credit unions, the best interest rate is going to be 0.5% that the credit union is going to give you, right? If you're on this call and you're living in the United States and you're keeping your money in the banking sector, nobody gives you more than 0.5%. Just so you know. Unless you have a CD, then nobody gives you more than 0.5%. That's a credit union, okay?
I mean, but there's some accounts that give you 0.75. Just saying. So,
0.75, you have a CD, you don't get into a regular bank account. If you take that 0.5, if you take 72, right, and divide by 0.5, what does that give you? It's technically 144 years. So your $5,000 in that bank, if you keep it there, before it becomes $10,000, it's going to be 144 years. Now, I don't know how long you want to live. I'm certainly not going to be 144 years old. but and they are charging you whatever 18% or what have you, and you're owing the credit card company $2,000. Take 72 and divide by 18%. That's at the number of years that debt is doubling. So you better pay it off. So it's interest and debt. So in general, that's how the rule of 72 is used. Not typically for protection need or life insurance product protection need.
okay,
Thank you so much so far. My co-moderator, Divine Chamakong, had a question, but it looks like he will not be able to ask it. But if it is available right now, he should go ahead and ask the question. Divine, are you back with us now? Not really. Last question, please, before our guest wraps up with his final thoughts. Anybody with a question, please? Okay, no question, but please, when you are signing up for an insurance policy, know that if you die prematurely, they will investigate the cause of death before they make any payments. That's my understanding. Well, our guest, please, Celestin, over to you to wrap up. What are your final thoughts and recommendations to our people?
Okay, thank you very much, Ni Asong and Ni Divine and all the listeners and to all the questions. This is really, wrapping this up and to say, yes, we discussed life insurance, but I want to go back to financial education. The way that the middle class gets into this, those of us that are out there, I'm an engineer, that's what I do all day. I never did any financial class. I want to tell you, if I can do this, everybody on this call can do it. We cannot, based on the questions, if we cannot go to work and think that because our employer is doing something, it's good for us. We cannot continue focusing on our work and think that the government is going to give us something. If we do that, we are going to be surprised at the end. It is important. I'm married with 2 kids. It is extremely important for us as we do our daily jobs to try to get some understanding of finances. Why do I say that? The reason reason why we leave what we do most times, some people are passionate, for some it's a vocation, but we want to make sure that you can put food on the table. We go to school, we do all this to improve ourselves. We cannot just go and bury ourselves on the job and think that somebody else is going to do that. Financial education is part of our responsibility. Everybody that has a family head, or both of you are heading it, is what we have to do.
Thank you so much. Thank you so much. Unfortunately, we're caught by time. But please, I know you're available on Africaonline WhatsApp group. People may still ask you questions during the week or today and tomorrow. Please endeavor to chip in and give us some answers. We appreciate all you've done. Yes.
Yeah, real quick. This is Ruben Pan. Mr. Atancho, I think we're going to put that information on our website. This information is very vital. So
I will do that, and I'll put my availability on the website too.
Go to Africaonline, www.
For us today, or stream this program for us today. We are very appreciative to our guests, and we are appreciative to all those who came in to ask questions or to just listen. Thank you so much. Next Sunday will be parenting for you and me in the diaspora and on the African continent. Have a good weekend and happy Labor Day, but please do not labor tomorrow on Labor Day. Thank you, and bye.
Bye.